I would love to be in a position of helping to create the space, the channel, the sleeve where capital can flow into net positive real estate. That would be an amazing outcome. And, it could start as an open-ended fund and it could become a REIT. And at this point, there are no real green REITs in the country that are known as being, a very high level of sustainability and are public, where anybody can invest in, the future wellness of the planet. I think that would be an amazing outcome, as if we made it accessible to any investor anywhere in the world to accelerate green building.
Welcome to the Regenerative Real Estate Podcast, a show about human environments and how they can be used as a force for good. Conversations that educate and inspire people looking for a different way to do real estate. I'm Neil Collins, and on this episode, I'm joined by Paul Rabinovitch, a professional with decades of experience investing in impact projects, who is the managing partner of Net Positive Capital. For those of you that have been tuning into the show over the past year, you'll have witnessed this theme emerge around capital and aligning investment into regenerative projects. The guests that have come on lately have primarily been from developers and project leaders that at one point or another have needed to secure investment in order to bring their project to life. For this episode, though, I wanted to reach out to someone that has experience on the other side of that coin as the investor. I can tell you, there really aren't that many people who have significant experience working within investment firms and family offices whose role it is to direct investments solely into impact projects. That's why it was a pleasure to have Paul Rabinovitch join me for a conversation. Now, I want to preface that I realize these conversations around money is different than earlier themes of the show. We're not going away from those, I promise you, but we are deepening into what it really takes to create regenerative projects. I also realize that regeneration is a concept that for many who are unfamiliar with our work, see it just as a landscape practice. Take, for example, the only one-star review that the show has gotten from someone named William B., who said, and I quote, but I'm having to paraphrase due to confusing grammar, "I was excited to run into this podcast and thought I would learn a lot with the industry moving towards electrical and whatnot. I thought I would hear cultural practices, mowing practices, watering practices, the meats and potatoes about regenerative changes over common landscaping practices. So I will conclude that I am sitting here wondering what you guys do and how you call your landscaping company regenerative," end quote. Well, while stewardship of land is a major theme to the show, and we have had many landscape designers, farmers, and even landscaping companies join me, I sympathize with William desiring to gain more actionable landscaping tips. But to that I say, first, our company Latitude is not a landscaping company. And second, there are dozens of other podcasts dedicated towards environmentally conscious landscaping practices that I think do a tremendous job. What we are focused on with this show is how to create life-giving habitats, and by doing so, recast the real estate industry out of a paradigm of extraction and towards supporting thriving and resilient communities. Design, capital, stewardship, process, equity, materials, these are the bridges towards belonging, well-being, and wholeness. This is a show for the revolutionaries out there that yearn to create healthy, vibrant places. It is not just about gaining tips, but about how we all have the potential to integrate our life experiences and our values in order to create the world that our hearts know is possible. I urge you to reach out if you identify as one of those creators and have a project that you want support bringing into this world. Before jumping into the episode, though, I want to give a shout out to our friends at Humanize Wealth. This is a unique and extraordinary wealth management firm for individuals, families, and foundations who seek social impact, environmental justice, and shared prosperity, in addition to financial returns. It is definitely not every day that I come across a firm run by professionals that have extensive experience managing investment portfolios that care about the things that we so deeply value in the regenerative movement. They run their company very similarly to ours, where their approach is based on the quality of the relationships they have with their clients and creating personalized and values-aligned solutions for managing your portfolio. If you have interest to explore the purpose, power, and potential of your wealth, I highly suggest you schedule an introductory call with them by visiting humanizewealth.com. Now onto the show with Paul Rabinovitch from Net Positive Capital. Paul Rabinovitch, it's a pleasure to have you here. And I think a great way to start this off is how a Toronto boy ends up living in one of the more climate unresilient places in North America, in southern Florida. But I'd love to just pick that up, as I think there's some some irony in there a little bit.
Well, you know that all Canadians do eventually end up in Florida at some point in their life. We call it snowbirds. You could call it Canada Goose, but you're right. I'm Canadian by birth. I was born in Montreal and went to school there, and then went also to University of Toronto for my undergraduate. And now I live in South Florida, at Boca Raton. Climate-wise, definitely the opposite. Probably long-term resilience, environmental resilience, also the opposite. Will be the first to flood here. But
you get it while you can, you know.
That's right. In the meantime, I'm having a great time gardening in the tropics. I've been an avid gardener slash farmer my whole life, and never had an opportunity to grow tropical fruits before. Now I'm growing sour sops and mangoes and pineapples and loquats, and it's fun. It's been really interesting.
There's no plantains in Toronto, and there's northern latitudes. Who would have thought? Well, Paul, I know that you've got a really interesting background, and on this podcast, we've been holding a lot of capital conversations. I think this is one of the crescendos of a months-long build-up into, where do you get purpose-driven projects funded? How do you put them together? What's the strategy behind it? Who's funding these things? And then to have somebody that's worked within that structure of where a lot of wealth is concentrated. But I want to back up, because I think following your career path, there's a thread there that I want to tease out, because it looks like you've got a lot of the trimmings of a very academically trained developer and investor. It looked like there's urban planning in your background and masters of real estate finance and things like that. Where did that curiosity come from a young age? I mean, was this just an urban experience that you naturally thought you'd want to work within creating towns and cities?
Yeah, that's a great question. Well, I think the largest part of my career has been focused on creating social benefits and impactful projects. And I would be remiss to answer your question, but not to also call out my mom, who is an architect by training and essentially taught me the business. Sharing her passion. Whenever we traveled, we would end up looking at interesting buildings and neighborhoods. And I would just hear her talking about the fabric of that neighborhood, or the fabric of that street, or the sort of the cadence of a neighborhood. And I just kind of picked it up, and it made sense to me, and as I was saying earlier, I love to garden, and I love regenerative agriculture, and I love biology. I spent almost 8 years working at the Nature Conservancy, mostly on their real estate side, but learned a lot about biology and the creation of mature plant communities. And I think there's a lot of relevance from the biology world to the human world, the built environment of, colonizing species and the whole ways in which communities go through these different stages from, you know, artists and lofts to restaurants and a hip community and then a mature community. And, there are a lot of parallels, and I just kind of mashed it all together over my career.
Well, so let's actually pick this up with the Nature Conservancy.
Yeah.
And why the Nature Conservancy to start off with? Was
Yeah.
that random, or were you really targeting that group?
So a couple things. I had just finished my master's degree in real estate finance and urban planning, a double master's. And I thought I would take that high priced education and immediately go to the lowest paying job I could find. Just kidding, sort of. My parents were a little chagrined about that decision. But there were a couple things that were going on there. One was just like a desire to make a difference. And then two was the opportunity. And one thing that I'd say to your younger listeners, or maybe just starting in your career, is what I found in the Nature Conservancy was that a 20-something-year-old, I was mid to late 20s, I was given so much more responsibility for negotiating real estate deals from commencement to close on a high volume level than I would ever be given if I went to work for, like the Goldman Sachs or the Blackstones of the world. And I just had this one little part to do. Like, you just look at the numbers, right? And you give me the report and I'll go and I'll negotiate. Like, I was given all of it as a nonprofit director with a very large budget. And so I felt like the trade-off was great from my perspective. Is I got a lot of experience. I negotiated a lot of deals, and we did a lot of good. So I was then able to take that experience and bring it to the for-profit side, which is what I did after the Nature Conservancy. I went into business as a brownfield developer and used all that, training of finding good land, negotiating good deals.
And what kind of stuff were you doing there, Paul? When you say brownfield, I mean, you could be doing a number of different things.
Yeah. So for a time, I ran a company called TerraCycle Investments, and that company was a brownfield redevelopment company and green development company. So brown to green, a very early antecedent of impact investing in real estate. And to give you an example, we bought an abandoned scrapyard that was a Superfund site. They had a whole bunch of buried toxic drums underneath the scrap. They also had a body underneath all that scrap, which is a whole other story. But when we were cleaning up the property, we found a body. We had to call in the police. It's a whole story. It was a little crazy. Freaked out our team there. But we bought buildings like that. We bought a hospital. We bought a lot of old warehouses and restored them. We bought an energy company transformer site and redeveloped that to affordable housing for seniors. So a huge diversity of different types of real estate that all had contamination, but they were, and this is the part that, that I really wanted to bring from my Nature Conservancy days, is they were well located in the prior industrial age because they were next to water, and they were or on a river or close to a highway. Then in our current time, they should be recycled. They shouldn't sit there, as land that we don't use anymore because they're still very valuable. But you had to overcome that cleanup risk and understand the cleanup risk in order to properly price the land. So I found that hugely gratifying to recycle land in sort of close in urban or municipal locations.
It seems like a lot of people it's like, what's the investment thesis? What kind of projects do you really want to get good at? This sounds like a bit of the opposite of, as long as it's brownfield, we're going to go after it. How do you develop the aptitude and the competency to work across so many different project types?
Some of it is learning as you go. In my brownfields business, it was really the part I already understood how to value land and understood what made land valuable in terms of being in the path of development or being in a desirable neighborhood. Like, I could already read where the path of growth was heading and could predict that for the land. The part I had to get comfortable with was understanding the risk of the land, which would be for brownfields, the cleanup, how much will it cost? And is there any risk profile there that I couldn't contain through insurance or legal agreements or what have you? And then the entitlement risk. Like if I come in as the white knight and I clean up this toxic site, is the community going to give me a hard time when I want to rebuild it into something to recoup my investment? Is that or is that going to be something that I get the benefit of the doubt for? Can I get through entitlements faster? Like so many times developments on greenfields can take 4, 5, 6, 10 years, to be developed. In brownfields, it's usually shorter. So I found that very attractive because you're partnering with the community in a way, and you're saying, hey, I'm going to get rid of something that's reducing your property value. That's a blight on your community. I'm going to put something nice and new here. Can you work with me on that? And most people would say yes. That sounds like a reasonable proposition. you know.
And so from the private development side, where do you go from there? I know that there's a couple more companies and activities that you've done since then.
Yeah.
And let's continue to find that thread.
So we were able to sell a portion of the portfolio, and that then sort of freed me. The real estate development business, you're very much tied to place. The projects that I worked on brownfields were very labor intensive, and you sort of had to be close to the site. So everything that we worked on was within a 2-hour drive of where I lived. So we sold a portion of the portfolio, and that sort of freed me up geographically. My wife really wanted to move to California, where she had spent a lot of her time. And I was fortunate enough to get an offer to go to California and help launch a fund to develop some of the most highly sustainable single family homes in Northern California. That was the thesis of the managers that hired me. Were like, can you come in here, help us raise the fund and think through super high sustainable real estate from both the energy efficiency perspective, but also health and wellness, air quality, water quality, light quality. And it was originally the thesis was around luxury homes, but then the concept was to bring the price point lower, it's sort of like Tesla, learn how to do this really well, and then get into a place where you can be more production minded and bring the price point down.
Okay.
Yeah.
So
yeah.
more health minded consciousness coming out, and it's that wellness theme that also it seems like it's gained a lot of traction, and the conversation around materials has evolved a lot.
Yeah, you're exactly right. In those days, Telos was just starting, which is now the Well Institute, I think they call themselves.
So they've been on the show.
They've been on the show, right? So yeah, we were in meetings with them about being the first house ever going through their system. And then after doing that for a while, I was hired to start the real estate team for a family office. The firm was called New Island Capital Management. They had a few $1 billion under management, and their mandate was 100% impact investing with an emphasis on sustainability. They already had private equity, private credit, real assets, and they wanted to build a real estate strategy. So they hired me to build the strategy, build the team, deploy capital into real estate to achieve, high levels of sustainability. And I did that for roughly 5 years.
Why do you think they had that directive of wanting to be, did you say 100% impact? Who is making that decision, and why do you think they made that decision?
The family themselves made that decision. The family matriarch wanted her wealth to be invested in alignment with her values, went to all of the wirehouses, the big shops who offered her sort of screened investments like, well, if you put your money in this, it won't do any bad. And she's like, no, I kind of want my money to do more good, not less bad. How do you do that? And everyone was like, I don't know. She's like, well, we have enough capital here that we can just figure it out for ourselves. And that's how she started the firm and started us on that path. Impact investing, investment opportunities that produce a double bottom line return, a real return that's comparable to if you just did a conventional investment, as well as a real bona fide and measurable social impact return. And that you could look at in a lot of different ways, but she really cared about the environment.
Hmm. And how do you start to begin to put strategy to that with a directive or really a compass heading of, I want to do good with this wealth?
Well, I think it was very helpful to us that she had given us sort of like the broad parameters of, I want it to be in the environmental sphere. So that helped narrow it down some. And then there were some other parameters. So there's some asset classes that get disqualified. Like in those days, self-storage, I could imagine myself going to investment committee and, her saying, well, you want me to invest in things where people store their SH-T? Like, what's the benefit of that? Right? So that's off. Industrial, what can I do on industrial and moving things from A to B? Like that didn't really fit very well in our mandate, but office, mixed use, senior living, all of those things, we could see a way in which we could deploy capital into those asset classes in the right locations and be able to create an exit that was meaningful financially as well as from an impact perspective. So we aimed to try to develop to a net zero standard. Didn't always achieve it, but was our aim from inception. And I think from a strategic perspective, those strategies were to go deep on the assets. It's a deep asset play where each asset that we produced would be, at the very highest level of performance of anything. We would set the bar every time we built something. Like this is what, one of the highest rated, some of our projects were written in all kinds of case studies and all those sorts of things. So that's one way to do it is to just build terrific assets and then bring those to market. None of them were ever sold, haven't been sold yet, but if they ever are, then it kind of creates a sort of a follow-on impact effect where it's now part of JP Morgan's portfolio. Now they own the asset and that becomes passed on to, other players. The other way to play the asset strategy game is, and we did this as well, instead of going like a mile deep on each asset, is to go thinner but broader. So we had a partner who we worked with on doing what I'd call medium touch sustainability on lots and lots of apartments. So that was with one sponsor buying buildings that were around 200 to 400 units, multifamily, garden, usually garden style, and going through all of the units, upgrading the HVAC, upgrading the LED lights, the controls, and getting rid of carpets and putting in like more sustainable materials. And that was it. Like not going too overboard with trying to get to net zero, but it was like, can we make this very conventional kind of a building more sustainable incrementally, 25% better? And so we did that strategy as well. It was like, can we just touch lots and lots of units, across the country?
Yeah. Interesting. And so from the investment directive of you want to do good, were you doing any direct investing or was it all through finding the operators and developers and either joint venturing or investing equity into the projects or funds?
We were a very small investment team. There were only 5 of us. And therefore, it was almost entirely through joint ventures and working with sponsors. And, actually, that is a great question because one of the early things that I found out from this work was that in a lot of times in real estate, you think about, well, what's a great market to invest in? Should I be in Portland? Should I be in Denver? Should I be in Nashville? Right? Like there's all these great up and coming markets or stable markets, and people spend a lot of time studying the data, figure out the markets. And to a certain degree, that was a little bit irrelevant to me because I couldn't go to, pick one, Nashville, and find a conventional developer and tell them, okay, go build this for me. If they didn't have it within them, like as part of their ethos, I would have very poor results. And we tried a couple times to do it. So I had a little bit of a different search parameter than a lot of other asset managers like us, or asset allocators, is I'd go find partners first. And then wherever they were working, I would underwrite that neighborhood or that community and make sure I was comfortable with it. But I needed to feel comfortable that the sponsors and the capital were aligned, looking at the same goals in the same way. If we weren't, wouldn't work.
How do you do that, Paul? I mean, do you wave a flag and say like, "Hey, if you need capital and you're doing more sustainable projects," or do you go under the radar? Like this, I think this whole world is shrouded in mystery that I think would be really helpful to understand really how those partnerships are made.
A lot of the times I would find the sponsors. I would reach out to them. I would say 8 times out of 10, the inbound people who found me were not in the right place for us. So a lot of the times, like, that was part of our job, was to research who we thought were doing great work. A lot of developers start with friends and family capital, and they build projects at whatever scale their friends and family can help them fund. And then, they do that. And so to us, we'd be looking to, I guess you would call them emerging managers, right? Like, if they had been successful in using, let's just say, 3 million of equity and developed a really successful, impactful project with 3 million of equity, we'd be interested in talking to them about what they could do with 10 million and help them make that next step up. So we were frequently researching that. And there's, we would be looking at conferences and different green building conferences, as well as like capital conferences. And then I guess the other thing to say is that there's just not that many of them in this country. So, it's not like we have a cast of hundreds to choose from. It's definitely not thousands. I mean, we have a cast of like less than 50, let's say, in the country, who are talented, great, bona fide, with track record green builders, impact developers. It's kind of sad, actually. I wish it were bigger.
Do you see that number going up?
Slowly, not exponentially. No.
Why do you think that is? I mean, it's certainly not out of the realm of a possibility for people to be putting together phenomenon of what's happening outside and what's happening within our towns and cities to realize, like, we need to change something.
Yeah. So I think a couple of things. One is real estate's slow to adapt. It's just always been an industry that doesn't evolve that quickly compared to like tech. And I think the other thing is just like the times that we're in right now, with interest rates high and, debt somewhat scarce and high interest rates. I just think that there's a lot of money on the sidelines, as well as developers waiting for like maybe a better time. Like maybe this isn't the best time. It's sort of, it's an interesting question. Like what is a good time, right? Like the last economic cycle we were in, where money was really cheap. Like that's when we should have been building everything green possible, but we didn't have the regulatory framework to force people to do it. Now we're starting to have the regulatory framework, but we don't have the capital. Like when is a good time? I don't know.
Yeah. And this is where I think part of the hope of the show is to help people integrate in that you can get away from the conventional side of the industry and not get away from it in the sense that like there's a completely new model and framework that's out there, but it's actually used that experience that you had. I mean, we had multifamily experience and we're trying to take that and say, okay, now we can do development differently because of this. And we understand the transaction and the capital stack. And so hopefully there are more developers out there that are recognizing the market is going in a different direction. And right now we have to go in that direction, or else it's going to be even more dire.
Yeah.
Um,
Yeah.
so yeah, it's interesting to hear you say, like, if you want to go find operators, it's still a pretty short list of people that are going to be doing that. And so your time with that family office, would you say it was it fruitful? I mean, did you enjoy moving from being an operator into being an investor?
I really enjoyed that whole process. I enjoyed the rigor of investment committee and due diligence. It's different from an investment perspective than it is from a developer perspective. And I enjoyed kind of sharpening, I guess you'd say, sharpening my impact measurement skills, like what really is impactful, and I think all of those things were really great about the time there, and impact can be a lot of things to a lot of different people, and it's not just about the environment. It's also about how you're treating the community, how you're creating opportunity for people in the community, governance and transparency. All of those things come into impact. And I think understanding all of those dynamics and all of those levels is really important.
What ended up happening with, was it New Island Capital? Are they still around?
No, the family decided to close the firm, and it's no longer there. The family's funding went to a different manager.
I want to take a quick opportunity before we continue this episode to talk about the work we are doing at Latitude Regenerative Real Estate. We see real estate as a catalyst for regeneration where we can change the way that we inhabit the planet. The hard part, though, is that real estate is complex and it requires specialized knowledge in areas around design and planning, capital and investment, and community engagement and construction. That's why at Latitude, our work goes to serve those that seek to create legacy projects that strengthen communities and develop ecological resilience. If you are needing help putting together a project like this and could use an experienced and dynamic development and sales team, we hope that you'll reach out to us at chooselatitude.com. Okay, let's get back into the episode. So what did that mean for you? What was next on the horizon?
So what I did next was I took a little break and just went to the beach more here in South Florida.
Nice.
And then I wrote a book, sort of encapsulating all the stuff that I had learned from, over the last 15, 20 years. So I wrote a book called Investment Opportunities in Decarbonizing Real Estate, which takes a look at the changes that are happening now and will accelerate over the next decade in decarbonizing real estate, and looking at over the short term, the medium term, the longer term, which asset classes, which geographies, and why. Why are things changing? So that came out about a year ago, and since then I've been consulting on a few very high sustainable and impactful projects across the country, and working on launching a fund that builds on the findings of the report and then creates a thesis around that to deploy capital.
And so that is Net Positive Capital. Is that right?
Net Positive Capital is that's right. That's the name of my company, and will be the name of the fund. Yep.
And where do you want to go with that? What would success look like to you?
I think, one of the most impactful things that you can do is to change markets and to create markets that didn't exist before and to create new flows of capital. And so I would love to be in a position of helping to create the space, the channel, the sleeve where capital can flow into net positive real estate. That would be an amazing outcome. And, it could start as an open-ended fund and it could become a REIT. And at this point, there are no real green REITs in the country that are known as being, a very high level of sustainability and are public, where anybody can invest in, the future wellness of the planet. I think that would be an amazing outcome, as if we made it accessible to any investor anywhere in the world to accelerate green building.
So this is taking a little bit of what you've done and wrapping it all up in one, it seems. Is this a different process for you to go out and it sounds like you were hired to create a fund to do sustainable homes in California. Yeah. And then you were hired to put together strategy and allocate capital for a single family office. And now it's like you get to wear that principal hat, raise the funds and allocate them. And you get to create the strategy. So what do you think that strategy looks like? How are you going to really stand in those shoes to create the impact that you're looking for?
Yeah, I think it's a great question. The places that we would probably focus on most would be in the value add and core plus strategies. So what that means is we're taking assets that are lower level performers and creating value by creating decarbonization. So taking properties that may be facing future regulatory penalties and moving them into a profile where they're highly energy efficient and future proof from regulations, and then selling them. And then so we've de-risked the asset from an environmental perspective, and we've passed it on to another buyer who will, we hope, if we're right, pay us for removing that risk from them, right? And give us a better price because they can see the value that we have created in the asset.
So you're going to be doing direct investing,
yeah,
and not partner with operators?
Well, the other part of it is maybe we're also going to do some work with my partners from New Island and bring capital to them. It's a business that I've been in for 5+ years, understand it well, know those players well, and one aspect of it is to buy their early projects from them. So we're buying their 30 unit apartment buildings or 50,000 square foot office buildings that are net zero. They're getting capital from that transaction. They can use it to build the next project. We have something that's stable and highly energy efficient that we add to our portfolio. So, a lot of those assets are what you might call sub-institutional, not quite the size that an institution would want to buy, but I think our fund would. And as our fund grows, it's accretive to have, a number of these projects all over the place. And, so that would be the other part of the strategy is buying stabilized net positive buildings.
There's certainly not many people doing that.
Nope.
I can tell you that.
No.
And so where are you going to, and whose doors are you knocking on, Paul, saying this is what we want to be doing? Do you want to write a check and invest into this?
Well, I'll share this. I can't give specific names, but European investors and family offices have been doing this a lot longer and have a lot greater appetite than American investment community does at this point in time. And I would lump the Canadians in with the Europeans. And I guess you could say that a reason for that is when, and I don't want to get political here, but for a time under our former president, we were out of the Paris Climate Accords for 4 years, whereas everybody else in the world went charging full speed after the commitments that they made in the Paris Climate Accords. And so those countries are 4 years ahead of us, 5 years ahead of us. And they already have regulatory systems that are in place. They have more mature investment approaches to valuing these assets. And they're interested in the American paradigm and seeing if the American paradigm tracks with the European or Canadian or in some cases Australian markets.
Oh, that's wild. And so do you see more family offices within the United States? Are they paying attention to that trend?
Yes, they are. I can't give you a number, But I know there are more and more conferences on the topic, more and more family offices that call me and want my opinion on things, and more discussion of it than any time in the last decade. I
Yeah.
don't know if it translates to more money going into these projects. I don't know if I have insight into that, but
Well, you got to start somewhere. More phone calls will
right.
trickle into more investments at some point. What do you think needs to happen to mature the capital landscape for impact, sustainable, regenerative real estate development?
Huh. Well, we have tried in the United States for over 30 years to create green buildings on a voluntary basis. And, using feel good approaches like getting a plaque on your building from the United States Green Building Council. Right. So that's all voluntary. Like, you saw a value, you didn't see a value, it was your choice. You can invest the money to get the plaque, right? Get the certification to be LEED Gold or Green Globes or Energy Star or any of those kinds of things. It's all voluntary. And when you look at the data and when you look at how many green buildings there are in the US and what their environmental profile are, the numbers don't lie. Let's just be honest with ourselves. It didn't work. It didn't work. We did not move the needle in the last 30 years, even though we've had all this talk about the environment and all these ratings and whatnot. When you look at our building stock, we are not more energy efficient than we were 30 years ago. Sorry. Just facts. So what is going to change the dynamic? Having regulatory systems engaged with market systems, and we'll get that flywheel moving. And I'm a pretty firm believer that the government needs to step forward and start to set some building performance standards and penalties, right? So when you look at the Europe, we were just talking about Europe. When you look at Europe, it's a top-down approach where the sovereign country has said, we're going to commit to getting, the 1.5 degrees below pre-industrial levels by 2050, and have basically charged all the municipalities underneath there to figure it out. Like, go for it, do it. In London, if your building is below a certain performance standard, you are not allowed to release it, get a new tenant until you bring the building up to code. So you have zero income until you improve it. Like, that's their approach, right? There's other approaches where you get a fine, right? If you're below the level. But essentially in Europe, from the top down, they've said we are going to change the performance of buildings. And the reason being is that buildings produce 40% of the carbon emissions in the country. But in cities, it's almost 70%. So really important to look at what city municipalities can do with their building stock if we want to try to improve performance of buildings across the country. So that's the European model, top down. American model is the opposite, bottom up. So you have places like Washington, D.C., New York City, Portland, Seattle, who have all set up their own building performance standards. Most of them are on a carbon tax kind of a model, or a fine if you're above a line, and that is creating market rigor. Now there's a cost, right? Is this the idea of environmental externalities? If there's no cost to doing bad, then markets don't respond. If there's a cost, it becomes risk. Now the market responds. So I think it's really important that cities and states continue to establish building performance standards so that the market can understand like what the risk is, and price that in to how much equity costs, how much debt costs, and things like that. I think that's a really important aspect of it is regulatory progress. And then the other part of it is there's parts of the real estate world that are beginning to understand the risk. You probably read about insurance companies leaving Florida, insurance companies leaving California, and insurance companies now thinking about, well, we want our portfolio to look a certain way in 10 years. So maybe we want, and banks are doing the same thing. Maybe we want to incentivize the green buildings more because that's the kind of asset we want to be a part of. So I think those mechanisms also inspire the market to do better. And then I guess I'd be remiss if I didn't say the Inflation Reduction Act and the billions of dollars that are being put into kind of accelerating this transition.
So this is
All of
this
those.
is a lot more political than I was expecting you to answer. And if that's the sense, we might be further behind than 4 years of pulling out of the Paris Agreement. Just because you see what's happening, like I get calls from developers that are like, we're just not going to develop in California because the regulations are too strict.
Uh-huh.
And you're like, okay, wow, that's interesting. So they end up going to these places like Texas or wherever. And I wonder if it's left up to states' rights, how long truly it's going to take to move the needle for those states to start to adopt more rigorous building standards.
It could take a really long time.
Yeah.
I don't know the answer to this, Neil. It's a great question to ponder, but how many wildfires, tornadoes, and hurricanes will it take before Congress acts? Because we keep getting the reminders, right? I mean, it's pretty obvious if you look at what the insurance losses, what the community losses have been year over year or by decade or however you want to look at it, it's escalating. Like, I get it. Like, okay, I'll go to Texas and develop there because it's easier. But like when your project floods in Houston, was it really a smart call? Right?
Yeah. Yeah. And this is on the heels of Houston just got smashed by a storm, an unpredictable storm,
Right.
last
Right.
week. And this is what really blows my mind is like you can go find capital raising groups, fund of funds that you have a whole ecosystem of people that will help raise money for your multifamily or RV park or mobile home park in Houston. But if you try to go towards the impact side, there's not a lot of people that are like, oh, yeah, I'll bring in capital towards that project.
Yeah.
It's very few and far between. And that's why I think, what does it take? Is it a premium? Is it regulatory frameworks? Is it catastrophe? And I know that none of us have a crystal ball, but it certainly seems like that there's a lot of things going on that would lead one to start to mature their thinking.
Yeah. I think it's all of those things. And I think, we need to have a little bit of humility, even though we see there's some urgency, but the impact side of real estate is nascent. It's young. It's just starting, right? So I would love to, like you, love to see an acceleration and a recognition of urgency and a lot more capital flows and a lot more developers getting it. But I guess I need to learn the patience too. Like
Yeah.
it's still young, right? Like we're still starting. Impact investing wasn't really a word 10 years ago. So
That is true. Well, Paul, what's some like imparting advice that you might have for people that they're intrigued by this industry of, we're dealing with place and with politics and with money. It's how we live. It's how we recreate. So they're intrigued by the industry itself, and they want to be more purposeful and work in this direction of doing good. What would you say to those, I don't know, I guess 20 and 30-year-olds that are starting out?
wow. Great question. I mean, I'm going to replug your podcast. Listening to podcasts like this, I think, is a terrific way to learn, right? And to be a part of the dialogue and hear what people like myself are thinking about with, some experience here for a couple decades and like what that arc looks like. But, I think also just like read the newspaper and be hyper local and check out like great projects that are coming out and like ask the questions like how did you build this and what were you thinking, when you built it? Like, what results were you looking to achieve? I think those are all great ways to learn. It's easy to walk through cities and towns and just see buildings, and I guess challenge yourself to look closer, like what is being built and why, and what's the direction here. I think that having that curiosity about where you live, I think, is super important to being a part of a community and being a citizen of that community and being engaged in that community. I was for a period of time. I was the chairman of a local planning board, and sat, listening to development proposals every Monday night, 7 p.m. to sometimes midnight, hearing both sides, developers saying one thing and community members saying another, sometimes diametrically opposed. It was a great process for me as a developer and as well as an investor to understand how communities are built, and go to a planning board meeting. Go see what the business really looks like. I think that if nothing else, bring some popcorn. It's a good show sometimes.
Yes, it is. That's some great advice. Go to the local planning board and bring a bag of popcorn. Well, Paul, this has been a great hour. I want to plug your book. People can find it on the CREO Syndicate, Investment Opportunities in Decarbonizing Real Estate. And where do you suggest people follow along in the progress and development of net positive capital?
Just follow my LinkedIn. It's my name, Paul Rabinovitch, on LinkedIn and Net Positive Capital. And I'll be updating everybody through LinkedIn, and we'll have a website at some point that people can go and take a look at. But hopefully, beginning of next year, we'll have something ready to bring out.
Excellent. Well, Paul, thank you for your time coming on, and good luck to you.
Thanks so much.
Okay, that is a wrap. Thank you for tuning in to the show today. If you got any value out of this conversation, be sure to subscribe to the podcast so that you don't miss future episodes. I can honestly say that these conversations have changed my life, my business, and how I steward my own home. If you want to learn more about our work at Latitude, where we partner with property owners, developers, and stewards to create thriving communities and resilient habitats, then you can find us online at chooselatitude.com. Also, if you have a project that you are needing help bringing to life or would like to align your investment portfolio with profitable investment opportunities that benefit communities and the environment, then you can reach out to me directly at neil@chooselatitude.com, and we can start a conversation from there. Okay, that's it. Until next time, here's a friendly reminder that the water we drink falls from the heavens. The air we breathe comes from the beautiful symbiotic relationship we have with plants. The food that nourishes our bodies come from the ground we so cavalierly pave over, and that we all have a role to play to regenerate this planet.